Hello, welcome to this video on why we reformat financial statements. To value a business, you need to first understand the business that you're valuing, and then you need to get a good understanding of the accounting of the business. In this topic, we're going to learn why it's important to reformat financial statements and how that can unlock new and important information about the business we're trying to value. I'm sure you're all familiar with the ratio return on equity. ROE, for return on equity, is one of the most important financial indications of a firm's performance. You hear it used in all sorts of cases for evaluating if a business is successful or not. And the return on equity formula that you would have seen in introductory accounting is net income divided by average owner's equity, or ROE equals NI divided by average OE. Just as a recap on how this ratio works, imagine I'm going to go and buy an apartment because I think it's going to be a good investment. So I save up $1 million, I buy an apartment in Sydney for that price, and then a couple of years later, I sell the apartment for $1.2 million. So I had owner's equity of $1 million because that's how much I had invested into this transaction. And I made a profit of $200,000. I sold the apartment for $1.2 million and I bought it for $1 million. So my ROE is the $200,000 profit divided by my $1 million owner's equity to get an ROE of 20%. You may have also learnt in your introductory accounting about Dupont Analysis. Dupont Analysis says, okay, that return on equity calculation we just did is useful, it's a good number to know, but let's understand what's causing or driving the return on equity. How is the business actually structuring itself to earn those high returns? So Dupont Analysis says the firm's return on equity is equal to the net income over sales, and we call that the firm's profit margin, multiplied by the sales divided by average total assets, and we call that the firm's asset turnover. And then we multiply by the leverage of the firm, the average total assets divided by average owner's equity. So the breakdown of Dupont Analysis allows us to see that the firm's operations, their profit margin times their asset turnover, that equals, when you multiply them together, that equals the return on the firm's assets. And that's really driven by your firm's operating decisions. What are we buying and selling? How much do we make the product for? How much can we then sell it for? How often are we selling the products? Profit margin and asset turnover. Then we multiply by our financing decisions. How have we actually financed the business? What is our debt to equity? What sort of interest rates do we have to pay on our loans? So we can separate the business's performance into the drivers of performance, their operational drivers and the financing decisions that we make that also drive performance. So while Dupont builds on the return on equity formula and allows us to learn more about the business and the drivers of its returns, there are still some problems with basic Dupont analysis. So if we look at that same example of I save $1 million and buy an apartment in Sydney and then I sell it a few years later for $1.2 million, now I'm going to calculate my return on equity and it's going to be 20%, the same as when we calculate it in the simple format. However, I can calculate my profit margin, $200,000 profit over a $1.2 million total sales revenue equals 16.67% profit margin. My asset turnover, my sales revenue divided by my average assets of the million, and the leverage of the transaction. $1 million assets over $1 million equity, my leverage was equal to 1. I didn't use any borrowing. And we multiply them together and we get an ROE of 20%. So the system's working, we have our Dupont analysis and it's working for that same transaction. We're getting the same return on equity. So let's start looking at some of the problems of Dupont analysis. I'm going to stick with my transaction where I'm buying an apartment in Sydney for $1 million and selling it for $1.2 million. This time I save $500,000 myself and I go to the bank and borrow $500,000 at 3% interest. When I recalculate my Dupont analysis and my return on equity, we'll see there's a few changes. First of all, my profit margin has changed relative to the previous example. That's because I now have an interest expense. So every year on the $500,000 I've borrowed, I have to pay 3% interest. And that interest expense over the 4 years lowers my overall net profit. So my profit margin has decreased. My asset turnover stays the same. And now my leverage has doubled. Now that I've got $500,000 of debt and $500,000 of equity, my leverage is equal to 2. When we multiply it all out, we see that my return on equity is now 28%. So in the prior transaction, when I did not use any financing, my return on equity was 20%. In this example, now that I've gone to the bank and borrowed some money, I've leveraged up my returns. My return on equity is higher because I was able to buy the same asset using less of my own equity and generate almost the same returns, just with a little bit of interest lowering my net profit here. So the problem is, I consider the buying and selling of the apartment here as my business, as my operational transaction. However, my financing decision, the fact that I went and borrowed money, actually lowered my profit margin as well. It also changed my leverage and influenced my return on equity as well. If I then change my financing decision, if I'm able to refinance the loan instead of at 3%, we have another example here where the interest rate has dropped to 2%. My profit margin relative to the prior example will increase because I have to pay less interest expense. So a financing decision here has changed my profit margin, which we would like to think of as an operating kind of ratio. And then my return on equity has also increased here. So the interest expense that changed the profit margin, which I was hoping would only tell me about my business operations, not my financing decisions. So this is a bit of a problem. My financing decisions are influencing my operational performance ratios. Another example of the problems, this time I'm operating a cafe and I have total assets of $100,000. My liabilities are equal to $50,000 and I've got owner's equity of $50,000. I had a profit of $25,000 during the term based on sales of $250,000. So we calculate our ratios. I've got a profit margin of 10%. My asset turnover is 2.5. My leverage is 2, and I get an ROE of 50%. So very, very successful, very high return in this case. Now I'm going to change the example a little bit. The business is just going to change one decision. On the final day of the year, I'm going to pay $25,000 in cash, which reduces my wages payable liability. So I'm going to pay my staff $25,000. I already owed them that amount. It was on my balance sheet as a liability. But this time on the final day of the period, I actually pay the cash out. So that means the business is identical. It's just instead of a liability, we've paid out the cash already a day earlier. My total assets reduced to $75,000, total liabilities reduced to $25,000. How does this affect our Dupont analysis? Well, it changes the asset turnover ratio because the assets of the business reduced. So paying a liability changed the asset turnover, and it also changed the leverage. So a simple operating transaction, that is paying staff their salary, changed my leverage and it made it look like my financing decisions had changed in the business. So this is actually an example of an operating decision changing my financing ratios here. Okay, so it leads to, when we're analyzing these ratios, it leads us to think that some of these ratios, my ATO has changed. That must be because of changes in my business model. But in this case, I just paid something a day earlier. Okay, so it wasn't a real big change that's leading to changes in these ratios. So both of those examples, the cafe example and buying a property in Sydney, and looking at the way the Dupont analysis changed based on changes in operating or financing decisions, shows there's some problems with basic Dupont analysis. We want to compare the operational performance of different firms without the effects of financing changing ratios. And traditional Dupont analysis does not cleanly separate the effect of financing and operating decisions. So we have a solution. The solution to this problem is that we're going to go through a process called reformatting the financial statements. And what reformatting the financial statements does is it separates all our operating activities from our financing activities. And that means when we then do an advanced Dupont analysis using the reformatted financial statements, only operating transactions affect the operating ratios and only financing transactions affect the financing ratios. And then we can compare different businesses based on their operations or financing and have a much better understanding of the drivers of the firm's returns. To further explain why reformatting is important and understanding that operating and financing activities have different effects on the business, let's zoom in on the financing activities and why we want to separate them out. The main reason is that firms create value when they earn a return higher than their cost of capital. So a firm's share price will go up when they're able to use their operations to generate a return higher than the amount that they have to pay their investors and their banks. Okay, that will generate value for the business. Firms create value with their operating and investing activities. That is their real business activities. Firms do not create value from their financing activities. They just distribute value from their financing activities. So things like buying and selling their own shares, paying dividends, borrowing money from the bank. These things don't create value for shareholders. They're just a way of getting money to then fund the operations, or they're a distribution of value to shareholders. So the reason financing activities don't create value is because they occur at the cost of capital. They therefore don't create value. Let's have a look at some examples. So here we have company A, who have 100,000 shares outstanding and a share price of $45. That would mean their market capitalization, the number of shares outstanding times the share price, would be $4.5 million. Company A decide to engage in a financing transaction. They sell an additional 10,000 shares at the current market price of $45. So this is a financing transaction. They're selling their own shares to raise cash from investors, and then they'll hopefully go and invest that cash in their business. Did this transaction actually create value? Well, the market capitalization of the firm does increase. The firm was worth $4.5 million, but now they've sold an additional 10,000 shares. The firm's value is now $4.95 million. So the overall value of the firm has increased. But if we divide through by the number of shares outstanding, the share price will still be $45 per share. So no value was actually created by this transaction. So when businesses buy and sell their own shares, that is a financing activity, they're unable to actually create value. They would be unable to sell more shares for $50 per share because if the market price is $45 and I want to invest in this company, I'll go and buy them on the market for $45. There's no way they'd be able to sell me shares for $50. That would be the only way they could create value, but I'm not going to do that. I'm just going to go and buy it for $45. Okay, on the other hand, this does happen sometimes. We've got company C here. They've still got the 100,000 shares outstanding and a share price of $45. They engage in a financing transaction and they sell an additional 10,000 shares, but they might sell it below the market value to really try and get people interested in this deal. They're going to sell the shares for $40. So their market capitalization increases to $4.9 million this time. The share price would actually drop a little bit. As you average the market cap by the 110,000 shares, you'll find the share price has dropped from $45 to $44.55. They've diluted the shareholding a little bit, so they can destroy value. So the lesson we're trying to learn here is from financing transactions like selling shares, you're not going to create value for shareholders by selling your own shares, but you may destroy value if you sell them for lower than market value. And that does happen for a range of different business reasons. So generally speaking, financing activities occur at the cost of capital. If you want to borrow money from a bank, they're going to charge you an interest rate that reflects your level of risk, and that will be your cost of debt capital. So going out and getting a loan on its own is not going to increase value for your business. If you've studied a bit of finance, you may have heard of the Modigliani and Miller paper, the dividend irrelevance theory, so M&M or M&Ms. Modigliani and Miller are sort of godfathers of finance, and they had this really famous study looking at how dividends don't affect firms' value. And they say that dividend payments are irrelevant to the value of the firm because paying a dividend won't create value and it won't destroy value. It's simply a distribution of value that's already in the business to shareholders. And they've got some nice mathematical models in there that explain how paying a dividend just won't affect the firm's value. So that's another example of how a financing transaction distributes value that's already in the business, but it's not going to create value. So to summarize what we've covered so far, what we're going to need to do moving forward to value a business is we're going to need to conduct an advanced Dupont analysis. The advanced Dupont analysis is going to separate the effects of financing and operating decisions and allow us to better understand the real drivers of business performance. But to conduct an advanced Dupont analysis, we need to reformat the financial statements. And to reformat the financial statements, what we're going to do is we're going to look at our balance sheet and we're going to look at all the different accounts and figure out which accounts are based on our business operations and which accounts are related to our business's financing activities. Then we're going to do the same thing with our income statement. We're going to look at all the revenues and expenses and try and figure out which ones are related to our operating activities and which ones are related to our financing activities. Thank you.